Okay, welcome to the video lecture for Chapter 7 on internal control. And remember, we're in the section of the course that's dealing with kind of how we do the audit. And we need to take some time to think about internal controls. And there are a couple of reasons why we need to think about internal controls. One, internal controls are the firm's response to the possibility of a material misstatement, right? So that's kind of the first thing. And we've talked about how also the auditor's evaluation of internal controls through control risk indirectly impacts their procedures in the sense of the quality of the internal control system changes control risk, and because of that it impacts the allowable detection risk, and then therefore the nature, timing, and extent of the audit procedures that are performed in the audit, right? So it's important for a couple of reasons. And this graphic is basically just a graphical presentation of those 6 stages of the audit process that we talked about in the last topic. And internal control basically hits steps 2, 3, and 4, or stage 2, 3, and 4, because we're obtaining an understanding of internal controls, right? We're assessing risk of material misstatement. That's the control risk piece. That's basically evaluating control risk. And it impacts our audit procedures because test of controls is part of that process to perform further audit procedures. So there are several learning objectives here. I'm just going to, off the bat, just knock off learning objectives 7 and 8, because those are largely going to be covered in later chapters, so we really don't need to preview them here. When we get to integrated audits and kind of wrapping up the audit, we'll talk about these in later chapters, so we really don't need those learning objectives 7 and 8, but so we'll just focus on learning objectives 1 through 6. So the first one is, or the first learning objective is, what do we mean by internal control, right? There are different definitions out there. Ultimately, they all agree it's a process, and for our purposes, we'll define it as one that's affected by the board, managers, and other personnel within the firm, and it's designed to provide reasonable assurance, which there's that reasonable assurance phrase. It applies to internal control just like it applies to audits, regarding achievement of the firm's objectives, right? And so there are 3 areas related to operations, reporting, and compliance. And in each of these areas, we're going to have these control objectives and sub-objectives. And we're not going to get into quite as much of the COSO internal control framework as you can. There's further layers that we would be able to go to, and you got a preview of that in the AIS class. But just know that this can be taken down pretty far. And so each area, like for example, financial reporting, prepare and issue reliable financial information will be a top level, and then we'd have detailed objectives. And I say we, the firm would have detailed objectives related to, for example, accounts receivable, right? Those would be sub-objectives. And so we'll talk about some of these. These will be controls that we would like to test as auditors, but the firm wants to make sure that these controls are operating effectively because, again, they're trying to meet these objectives using this process of internal controls. So the Foreign Corrupt Practices Act, this was something that was passed a while back, and the key part for us, even though it's related to kind of bribery and kickbacks, the key part for us is this requirement for effective internal control for publicly traded firms. And let's keep in mind too, it's a regulation. Firms had to have internal control systems before this was passed, right? It's not like this act introduced this novel idea of having internal controls. Basically, it just put teeth behind or consequences behind firms not having effective internal controls, right? Because firms have had internal controls for a long time, so this just provided some consequences. So learning objective 2 then is getting to the components of internal control, and this is where we get into the COSO internal control framework. And I'm not sure if you've seen this. This is the COSO cube, internal control cube. This is a nice way to see these three different dimensions of the internal control framework. We have the objectives up top, and that's the operations, reporting, and compliance. We have the components that are the horizontal slices, and those are the five components of the internal control framework: control environment, risk assessment, control activities, information communication, and monitoring. And then the idea that if we go into the depth of the cube, that's at different levels of the organization. We're going to have different levels of each of those components operating for each of those objectives, right? So you might have a control activity that's done at the C-suite or the CEO level, and then you're also going to have control activities that are done at the function level, which is kind of the lowest level of the organization. So understanding the internal controls, a good internal control system addresses all these areas in terms of the intersections of the objectives, components, and the different levels of the organization. So if we look at the control environment, the different things that can impact the firm's control environment, obviously commitment to integrity is at the top. The board being independent from managers. Remember we talked about this is we need independence of the board because they provide oversight of managers, right? And so we need to have that independence to make sure that as a control, it's functioning as a check on managers. Control environment also has to do with how the hierarchy of the firm works in terms of how authority is distributed, how the firm is structured, because we need to know who is responsible for what, who's been given authority to do things, and then who we need to keep accountable. Those are all important things. Making sure you have good employees is an important part of control environment. So the HR function would be a major piece. The quality of the HR function would be a major piece in the control environment. Making sure that employees are actually doing the internal control activities they're required to. All those things go into the control environment. Risk assessment is the next component, and so obviously here the key is there a systematic process that seeks to identify all the risks that could get in the way of the firm achieving its operational reporting and compliance objectives. And so risk assessment, once it identifies those risks, then the key is making sure the firm has a process to decide how they want to handle it, right? There are different ways to handle a risk. You can try to prevent the risk from occurring. You can acquire insurance in the event of the risk. You can have corrective measures, and you can even just allow it, recognizing that some risks it would be too costly to address the risk, and the benefit is not that great, right? So think about like a supply closet, and you've got pencils and pens and all that stuff. So you could have it very well controlled where if someone needs a pencil, they have to go and ask someone that has it in a locked cabinet, and then once the cabinet is, people give pencils out, then you have to sign your name and the item and how many and all that, right? You could keep track of those supplies at that level, but that's probably not worth it, right? So there's some risks that you just recognize are going to occur. And then obviously you're considering fraud in this risk assessment piece. And so also as the company is growing and changing, or possibly not growing, possibly declining, how might those changes impact internal control? So let's say you're acquiring lots of other smaller firms, and so the firm is changing a lot. How's that going to put stress on the internal control system? That is part of the risk assessment. Control activities is kind of the heart, what I think of in terms of the These are the actions that you would take that are more at the transactional level, even though there's some that are kind of a little bit above. But the performance reviews is one, but what you probably are used to is this list of 6 physical control activities, right, from your AIS class. Transaction authorization, segregation of duties, supervision, accounting records, access control, and independent verification, right? Those form the heart of the physical controls. And then you have a whole set of IT controls that are part of it as well, right? As more and more accounting information systems are dominated by information technology, then the expectation is that we're going to have controls built into the information technology, the software and the hardware, to try and make sure that those objectives of the firm are still being met. Okay, you can think about, I don't know if you've seen this for segregation of duties before or not, but you can think about segregation of duties at three kind of levels. The highest level is you want to separate out who gets to authorize a transaction from who processes it, right? So if you have a purchase order, like a request, is there the person who authorizes the purchase order, are they separate from the person who completes it, sends it off to the vendor, all those things? That would be an example of that highest level. The most common one that I usually think of and encourage students to make sure they understand is this control objective 2, where you're separating out who gets to authorize, and then you're going to break processing out into 2 pieces, right? Custody and record keeping. So who has custody of the asset in question, who has recording or record keeping responsibilities in terms of entering information into the accounting system. All right, we want all 3 of those separate. And we'll see examples as we go through the different transaction cycles. But if you can get segregation of duties, strong segregation of duties in the firm, that goes a long way to preventing fraud and even errors, right? Because we don't want the key is we don't want one person to be able to perpetrate and cover up a fraud, right? And so we want to separate out the responsibilities for a transaction to try and reduce the likelihood we'll have fraud. Another objective is to separate out the journals from the ledgers, right? So who gets to enter entries into the journals versus who gets to post to ledgers. Obviously, with accounting software these days, a lot of the posting is done automatically by the software, right? So we see less of that. But you can still have, for example, a general ledger department, and they're responsible for maintaining the general ledger, for making sure the general ledger is correct and free from errors, and you would want them separate, for example, from the group that is largely responsible for example, entering in sales orders, right? That would be kind of more on the journal side. Okay, so these are the different levels you can think about segregation of duties, but again, segregation of duties is probably the most important physical control out of the 6. Another component of the framework is information and communication, and so this is essentially what kind of attributes do we want to have our information to have. So validity obviously is important. We don't want invalid transactions that are going into the system. Don't want made up invoices, for example. We do want the information to be timely, right? We don't want it to be stale. And so if you're engaging in a purchase of inventory, you want that transaction to be entered in fairly quickly into the accounting information system, right? Could just at the very least think about when it's time to order more inventory, you want to know what the current level of inventory is, but if you're not recording on a timely basis the purchase of new inventory, then that current inventory level will not be up to date. Obviously, we want accurate measurement. We want things to be put in the correct time period. One of the easier frauds to do is to try and push transactions from one period to another, right? So you either try and push an expense from the current period to a later period, or you try and bring in some revenue from a future period into the current period, right? So having them in the correct time period is important. Obviously, presentation disclosure as well. Okay, another component is monitoring, right? And monitoring is basically monitoring of the internal control system to make sure that the internal control system is operating as it's intended. And so you can have these ongoing, you can have also non-routine. For example, internal audit is an important part of the internal control system. They're in the monitoring component because they don't do any of the transactions, right? Internal audit doesn't record any transaction. They come in after the fact and make sure that the transactions that were recorded were recorded appropriately. Some limitations. Obviously, we can have simple errors, right? We have people that are still involved, and so we're going to have errors. And even in software, even if we have things more automated, we still have people that are programming the software, right? And so errors can be made even in information technology. So while computers don't generally make a mistake, they do what they're programmed to do. We can't have individuals that program them incorrectly, right? Or maybe we don't take good care of our hardware and we have it sitting in a place where it gets overheated, and so information can get corrupted, right? So there's still limitations here from errors. People may do things on accident. And collusion is a limitation that can get, or is something that can get around segregation of duties. Even though segregation of duties is our most important control, if you get enough people on board, then you can have collusion, right? So, and at the end of the day, that's kind of what we want. If there's going to be a fraud that's perpetrated, we want to force collusion in the sense of it's harder to get a group to agree to commit fraud than it is for an individual to decide they want to commit fraud, right? That's a hard conversation to start having. Hey, what do you think about defrauding the company, right? That's a hard conversation to have, and so collusion is just a necessary limitation, but it's better than having just one person. Management can override internal controls, right? They sit on top of the internal control system, and there may be times in which management override's appropriate. Maybe they're trying to get a rush order out to a key customer, and if they don't, they're going to lose a contract, right? So they can't jump through all the hoops they normally do, and so that's a limitation. But we're going to spend time, or the auditors will spend time making sure that they can evaluate that, make sure it's appropriate. And the idea that compliance may deteriorate over time, right? You put a new rule in place, and usually you get strong adherence at first, but over time that may fade. All right, so we can classify the controls, and again, most of the time when we're thinking about the internal controls here, we're going to focus on internal controls over reporting. That's usually where we're going to focus on, that one objective. Even though compliance is a legitimate internal control objective, even though operations is an internal legitimate one, we're going to oftentimes focus more on the internal control over financial reporting, just because that's the most common audit we're going to be dealing with is a financial statement audit. And so how can we classify the controls around reporting? So we can have preventive, right, that are trying to avoid the misstatement in the first place. So separating out the responsibilities among different individuals is preventive, trying to prevent a fraud from occurring in the first place. Detective is like it sounds. We're trying to, after the fact, find if anything has happened. So any kind of reconciliation, bank reconciliations, fixed asset reconciliations, anytime we reconcile the subsidiary ledger with the general ledger, all of those are trying to find if there's problems after the fact. And then corrective, right? So if we have, for example, a backup where we've had, let's say that some of our records were corrupted because the temperature was too high in the data center, well, we would go to the backups and then use that to correct the problem, right? And restore the transactions, at least to the best extent that we could, as the firm could. And then lastly, kind of this idea that they can interact, right? They can work together. They can be redundant in the sense of addressing the same assertion or control objective, and they can be compensating, right? So we're going to find examples of all three of those in any given firm, where some things might work together. Well, sometimes you might find some redundant controls, and sometimes that's an opportunity for the firm to improve their internal control system, or improve their operations, is by is by removing redundant controls. But depending on if it's a high enough risk area, you may want to have a redundant control, right? And then compensating is if we have a weakness in one area, then this other control can help kind of compensate for it. They don't necessarily work together, but one can help alleviate the weakness of the other. And then lastly here about internal control, enterprise risk management is another framework that COSO has. It's not a replacement for internal controls. It's an additional framework put out by COSO. It's trying to focus on managing risk and opportunities generally for the firm. And so we're going to focus just on the COSO internal control framework. Whereas the firm, for example, might use the enterprise risk management framework to do their risk assessment piece, right? And so we may look as auditors to see, okay, how does the firm use, or how does the firm execute their risk assessment? And so we might look to see, are they going to follow the enterprise risk management model when doing their risk assessment? And then if that's the case, then we're going to feel more comfortable about how robust their risk assessment piece is, but it's not necessarily the thing that we're going to evaluate. Or it's definitely it doesn't take the place of the internal control framework. It's really more like a piece for the risk assessment component, or I should say, it's a tool to do the risk assessment.